It was September 2019. The IPO was days away. $47 billion was on the table. Then it vanished, not slowly, not quietly, in 11 days. A company that had redefined commercial real estate collapsed in plain sight, in front of every bank on Wall Street, in front of every journalist in America, in front of the man who had bet more money on it than anyone in history. His name was Masayoshi Son, and he had just realized he'd been had. The man who took him there was Adam Neumann, a 6'5" Israeli entrepreneur with a messiah complex, and a gift for making billionaires believe they were buying the future. How does a company valued at $47 billion lose 80% of its value in a single month? How does one man convince the smartest investors in the world to ignore every warning sign? And how close did WeWork actually come to bringing down one of the most powerful investment funds ever created? This is that story. Adam Neumann was born in 1979 in Tel Aviv. He grew up in a kibbutz. He served in the Israeli Navy. He arrived in New York in 2001 with almost nothing. By 2010, he and his co-founder Miguel McKelvey had launched WeWork. The pitch was simple: lease office space wholesale, divide it, rent it retail. To freelancers, to startups, to anyone who needed a desk and a dream. But Neumann didn't sell office space. He sold something else entirely. He sold belonging. He called it community. He talked about elevating the world's consciousness. He said WeWork wasn't a real estate company. It was a state of mind, according to documents filed ahead of the IPO. The company's prospectus actually used the word community 150 times, in a lease agreement dressed up as a manifesto. Investors loved it, because in the decade after the 2008 financial crisis, Silicon Valley had taught Wall Street a new religion: growth at any cost, disrupt everything. Profit is old thinking. WeWork looked like a tech company. It moved fast. It had a charismatic founder. It was burning cash the way Uber burned cash, the way Snap burned cash, the way every unicorn was supposed to burn cash. By 2017, WeWork was operating in over 200 locations across the world. Revenue was climbing fast. SoftBank, Masayoshi Son's $100 billion vision fund, led a series of investments that would eventually total over $10 billion, $10 billion, in a company that had never turned a profit. Son had seen Neumann for just 12 minutes in 2017, according to reporting by the Wall Street Journal. Son told Neumann he was not crazy enough, that in a fight, the crazy ones win. He wrote a check that day, on a tablet in the back of a car. That check would nearly destroy SoftBank. The cracks were always there. The question is why nobody stopped. WeWork was losing money at a scale that defied comprehension. In 2018, the company reported losses of $1.9 billion on revenue of $1.8 billion. The Wall Street Journal reported those figures ahead of the anticipated IPO filing. They were spending more than they made, every single year, without exception, but the structure underneath the numbers was worse. Neumann had engineered a web of personal conflicts of interest that should have triggered immediate alarm. Court documents and the IPO prospectus itself revealed that Neumann had personally purchased buildings, then leased them back to WeWork. His own company was paying him rent, millions of dollars, through entities he controlled. He had trademarked the word we. When WeWork adopted the name the We Company, it paid Neumann $5.9 million. For a trademark he owned personally, $5.9 million. For a word. The Wall Street Journal and subsequent SEC commentary highlighted this as a textbook related party transaction, the kind that triggers regulatory scrutiny, the kind that reveals a founder treating a public company as a personal ATM. And then there was the governance structure. Neumann held super voting shares, 20-1 over ordinary investors, according to the original S-1 filing submitted to the SEC in August 2019. His control was so absolute that his wife Rebecca, a co-founder with significant internal authority, could name his successor if he died, not the board. His wife, Rebecca Neumann, ran programming for WeWork. She had co-founded a school attached to the company. She was deeply embedded in the culture Neumann was building. Critics and former employees described a workplace where spiritual language mixed with hard-sell tactics. Former employees, speaking to journalists at the Wall Street Journal and New York Magazine, described a culture of alcohol at company events, cannabis on company jets, a founder who surfed in company meetings, and a loyalty structure built around personal devotion to Neumann himself. Financial analysts at Sanford Bernstein and other institutions began publishing critical notes. They questioned the valuation methodology. They asked how a real estate company justified a tech multiple. They noted the lease liabilities buried in the footnotes, long-term obligations exceeding $47 billion. Sitting beneath a company with a fraction of that in revenue, nobody with power acted because the Vision Fund needed this to work. August 14, 2019. WeWork filed its S-1 registration document with the Securities and Exchange Commission. It was meant to announce WeWork's arrival as a public company. Instead, it announced its unraveling. The document was extraordinary, not for what it revealed about the business, for what it revealed about the man running it. Journalists, analysts, institutional investors. They read the filing and couldn't believe what they were looking at. The losses were staggering, nearly $900 million in just the first half of 2019. The lease liabilities were buried but calculable. The governance provisions were unlike anything seen in a major IPO, the related party transactions involving Neumann's buildings, the trademark payment, the dual-class share structure giving him near-total control. CNBC, Bloomberg, the New York Times, the Wall Street Journal. They all ran the same story within 48 hours. This company, valued at $47 billion just months earlier, was being questioned as worth perhaps $10 billion, perhaps $8 billion, perhaps less. The IPO was scheduled for September. The roadshow began. It was a disaster. Institutional investors, the pension funds and asset managers who actually buy IPO shares, refused to engage at anything near the hoped-for valuation. According to reporting by Bloomberg and the Financial Times, orders were not coming in. The book was not building. On September 17, 2019, WeWork officially postponed the IPO. The statement was careful and corporate, but the meaning was not. The market had rejected Adam Neumann. 4 days later, on September 24th, Neumann resigned as CEO. He didn't leave empty-handed. SoftBank, desperate to prevent a full collapse, negotiated a rescue package, according to SEC filings and reporting by multiple outlets. The deal included nearly $1.7 billion in financing for the company, and a personal package for Neumann worth approximately $1.7 billion, including nearly $500 million to buy back his shares, a consulting fee reportedly worth $185 million, and a loan forgiveness arrangement, $1.7 billion, to leave. The man who had destroyed the IPO walked away with a personal fortune secured by the same company that had just failed. SoftBank's Vision Fund took a direct hit of approximately $9.2 billion on its WeWork investment. According to SoftBank's own earnings disclosures, the fund reported a loss of over $17 billion in fiscal 2019. WeWork was the single largest contributor to that collapse. Masayoshi Son, the man who wrote a check in 12 minutes, stood before cameras in Tokyo. He said he had been foolish. He used that word, foolish. Here's what nobody is telling you. SoftBank didn't just lose money on WeWork. It nearly lost the entire Vision Fund narrative. And the consequences of that, for dozens of companies that depended on that capital, are still playing out today. Stay with us, because what happened next to Adam Neumann is perhaps the most revealing chapter of this entire story. WeWork did not die. That is the first thing to understand. After Neumann left, SoftBank completed a bailout. The company's new management, led initially by co-CEOs Artie Minson and Sebastian Gunningham, began a brutal restructuring, according to company announcements and reporting by the Wall Street Journal. WeWork cut approximately 4,000 jobs, that was roughly 1/3 of its global workforce, in a single round. Announced November 2019, 4,000 people, gone in months. The company continued to hemorrhage cash. It went public eventually, not through a traditional IPO, but through a SPAC merger with Bo X Acquisition Corp. That deal closed in October 2021. According to SEC filings, the implied valuation at that time was approximately $9 billion, from $47 billion to $9 billion in under 2 years. The stock continued to fall. By 2023, WeWork's share price had dropped over 99% from its post-SPAC peak. In November 2023, WeWork filed for Chapter 11 bankruptcy protection. The Wall Street Journal and Bloomberg confirmed the filing. The company listed liabilities of between $10 billion and $50 billion in its petition. The company that was supposed to redefine work went bankrupt. And Adam Neumann, he kept the money. The Delaware Court of Chancery became one arena where consequences were explored. SoftBank attempted to claw back portions of Neumann's exit package. A legal battle erupted over whether SoftBank had fulfilled its obligations under the rescue agreement. According to court filings in Delaware, SoftBank argued it was not required to complete the full share purchase. Neumann sued. The parties eventually reached a confidential settlement in 2021. The terms were not disclosed, but reporting by the Wall Street Journal indicated Neumann received significantly less than the originally announced total. The exact figure remains contested. Then came the twist. In 2022, Neumann launched a new company, Flow Carbon, a carbon credit startup. He raised $60 million from Andreessen Horowitz and others according to public statements from the firm, and then in 2022, he announced Flow, a residential real estate company focused on apartment communities, backed by Andreessen Horowitz again, with a reported investment of $350 million at a reported valuation of $1 billion, a unicorn, before launching a single product. Andreessen Horowitz published a blog post defending the investment. They argued Neumann had learned from WeWork, that he understood the problem space, that the team was strong. Industry observers noted the obvious irony. A man who had burned through $10 billion of investor capital had raised hundreds of millions more, within 3 years of leaving in disgrace. The SEC reviewed WeWork's IPO process and related disclosures, but as of the time of this Scripps research, no criminal charges were filed against Neumann, no fraud conviction, no personal liability finding related to the IPO. The system, by any measure, did not hold him accountable in criminal terms. Masayoshi Son restructured SoftBank. The Vision Fund slowed its pace dramatically after 2019. Son publicly acknowledged mistakes. SoftBank's share price fell significantly through 2020 and 2021. The company sold assets. It bought back shares. It survived, but dozens of Vision Fund portfolio companies, including Uber, Slack, and others, had their trajectories altered by the capital environment WeWork helped poison. The damage was systemic and largely invisible to the public. Here is the uncomfortable truth that WeWork actually reveals. The $47 billion valuation was never really about WeWork. It was about a story, and the people funding that story needed it to be true. They had already committed the capital. They had already told their own investors it was genius. When a fund bets $100 billion, it can't afford to be wrong about the first few bets, so it doesn't allow itself to see the warning signs. It calls skeptics short-sighted. It uses words like vision and disruption and long-term thinking to silence the people asking basic questions. Adam Neumann understood this better than anyone in the room. He sold certainty to people who desperately needed to buy it. That is not a crime. That is not even unusual in business. What is unusual is the scale and the speed and the brazenness. The man trademarked the word "we" and charged his own company for it, and the board approved it. That tells you everything about the culture he had built. Not a startup, not even a cult, something more dangerous. A consensus hallucination, where the belief was the product. And the moment the belief broke, there was nothing left. That's not a story about one reckless founder. That's a story about an entire financial ecosystem that chose to look away. Because looking away was more profitable, until it wasn't. Here is the question I want you to answer in the comments. Andreessen Horowitz backed Adam Neumann again, 3 years after WeWork collapsed. Was that a genius contrarian bet, or proof that accountability simply does not exist for founders at a certain level? Drop your answer below. And if you want more stories about the billionaires, the blunders, and the moments when the whole system nearly broke, subscribe now, because next week, we're going inside the collapse that made WeWork look like a warm-up.